Thank you very much. It's nice to see you all here. What we'll do is first start with the panel and introductions. Then I'll do a few slides just talking through some of the market trends that we see at the moment, and then we'll go on to a conversation. Please feel free to ask questions at any time. Just raise your hand, and we'll be interested to hear what you're going to ask us. So if we go down the panel, maybe Asun, you could start. You just have to turn your microphone on and introduce yourself and your company.
Good morning, everyone. My name is Asun Monfort. I work in the private equity team of HVM Partners. So HVM Partners is a healthcare investment fund that is located here in Switzerland. The fund is listed in the Swiss Stock Exchange, and it's an evergreen fund. Actually, we have around 2 billion assets under management. And we are organized in two teams, a private equity team, but also a public equity team. So we like to invest on both sides of the spectrum. Very nice meeting you all today.
All right, does that work? Excellent. So Dimitrios, Weedon-Topalopoulos, long name. So I work at OrbiMed, which, for anyone not familiar with it, is a specialist healthcare investor based out of New York. About $17 billion under management, split across 3 strategies. Classic venture equity, public long-short hedge fund, and private credit and royalty fund.
Good morning, everybody. I'm Inmaculada Valle. I'm investment manager at the European Investment Fund. We are basically the most active fund of funds invested in Europe. Roughly 90% of the funds in life sciences in Europe are part of our portfolio. And just to give you an idea, in the last couple of years, we have invested 700 million in 2021 and close to 1 billion in 2022, only in life sciences, directly in equity, in the funds.
Is that better? Normally, I don't need a mic, but anyway. Research arm of Bloomberg. We're a team of about 400 people across all the geographies. I've been there for 12, 13 years. At my core, in my genes, I'm a pharmaceutical analyst and a pharmacologist. But I also run a global research team with 6 industries that are the global industries: technology, energy, etc. So I have a slightly different outlook on things than totally focused on healthcare.
Good morning. My name is Stéphane Boissel. I'm the CEO of SparingVision. SparingVision is an ocular genomic medicine company that was started in Paris in 2016. We've raised 135 million in Series A and Series B. Our lead asset has started clinical development in 2023, and the lead indication is retinitis pigmentosa, which is the leading form of inherited retinal disorder.
I think I have to turn this one on too. Thank you. So I'll start with just running through a few slides. And I should have said, I didn't say anything about Stifel. So this is my first time presenting on behalf of Stifel, which acquired Torreya, which many of you know from the past. This is a an investment bank headquartered in the US with a large office in London and offices in Paris and Germany as well. So very nice to see you all here. So just to talk about just sort of the overall background on what's happening in the market, it's important to start with the overall market and to start looking at the macro trends. So what are the current key drivers overall in the market? I think everybody's looking at inflation and interest rates. I'll talk a little bit more about that in a moment. Earnings have been actually surprising on the upside across the market broadly, which is good news. GDP also has been improving. That's gross domestic product, a measure of the overall economy. And while we had some concerns about financial stability in the past, I think they're less acute than they had been at the time when we had the issues with, for example, Silicon Valley Bank or more locally, Credit Suisse. So those things seem to be improving. However, Treasury yields continue to rise, and so that's important for biotech. The light blue line here is the one-year Treasury rate, and the dark blue line is the 30-year Treasury rate. So the one-year Treasury rate gives you an idea of what people's expectations are for short-term inflation. The longer-dated interest rates give you an idea of what long-term inflation expectations are. And all of this is really important because when you're looking at valuing long-dated cash flows, which is often most of the time the case in biotech, that has a big impact on discount rates. And so hence we need to see some improvement in inflation and Treasury rates to start seeing a really vibrant biotech equity market. Overall in the market, equity indices are improving. That's all good news. These are some US measures, but across the board from the S&P 500, NASDAQ, et cetera, we're seeing positive momentum, better on things like NASDAQ and, than maybe the broader index, but still a positive market environment. And really importantly for biotech, there's a measure called volatility of the market overall, and it's important for financing that be low. So that's a very positive metric at the moment. We're at a multi-year low. We've traditionally said that when volatility is less than 20, that's a good market for financing riskier assets like biotech. So that's an important thing to watch. It's called the VIX. You can watch it, just Google it, and you can find the VIX, the volatility, which stands for the Volatility Index. Moving to biopharma, at the moment, so maybe a little hard to see, but the dark blue line here is an important biotech index called the XBI. You see that that's relatively flat year to date, despite some relatively positive news. But with these interest rate environment, that makes it more difficult. The green line is the S&P 500. So at the moment, the S&P 500 year to date has been outperforming the biotech index. In 2022, we had a lot of volatility in the market, much higher levels, as you saw. So that impacted investor sentiment and biotech equity transactions. At the moment, we're starting to see that the market is constructive. It's not wide open, but it's constructive, and the bars across the bottom show equity issuance over the course of this year. And so the market is open, and especially for catalyst-driven deals. So 70% of the follow-ons that have been issued this year have come on the back of an important news catalyst. We measure global biotech sector value, and you can see here that on the left is, sorry, it's hard for me to even see this, June 2021. So we're not at the levels of what we might have called the exuberant times of 2021, but we are in a market that's relatively stable for biotech value overall. In Europe, it's a little more complicated. So, excuse me, the gray line, sorry, the orange line here is the XBI, which is the index that I had been looking at earlier, which has been relatively flat. We just looked at measuring biotech companies in Europe. So if you look at companies that we call large caps, so greater than 2.4 billion, which is just a number that, where the numbers fall. And if you look at the mid caps, so that would be the green line and the gray line, interestingly, they're relatively consistent with the US performance. I should say, though, that the large cap at that level, greater than 2.4 billion, there's 4 or 5 companies, and basically argenx is the one that drives that performance, just given how large it is. The small caps, though, which is, here it says less than 250 million. We actually cut it from 50 to 250 million, and that is significantly underperforming. So the small and the mid caps here they're each about 40 companies in that list. There's a long tail of companies, about 140 companies that have a market cap quoted of less than 50 million. So there's quite a big bifurcation in this market here in Europe. We also track negative enterprise value companies, which is a bit disappointing to see that we still have this many. It's better than it was last year, but still 183 companies in the sector with a negative enterprise value, which means they have more cash than their market cap. This is a little hard to read, but we've been tracking since the beginning of 2022 valuation change in biotech companies by field. So you can see during that period of time, so the dark bars on the left are at the end of 2021, the dark blue bars and the orange bars on the right are last week. So basically you can see that there's been a pretty significant valuation shift. So things like protein degradation, cell therapies, gene editing have gone down quite significantly in terms of valuation. And the only area that's up is cardiometabolic, which is, perhaps not surprising given all of the, news in that space. We also look at biotech valuations by stage of development of the lead compound. And what we see, recently preclinical and phase 1 companies have been continuing to lose value while those that are later stage are gaining in value. And if you think about it, again, given the interest rate environment, the later stage companies are closer to their cash flows, less impacted perhaps than the earlier stage companies. In terms of equity volume in the US, that's normalizing in terms of numbers of deals with a brief pause for the summer months, but that's a good sign. And they're trading well, very importantly. So investors are making money by buying these equity transactions in biotech, which is great, and actually even outperforming the overall biotech index. So there are some, quite interesting positive trends happening here. Median proceeds also have increased 250 million in the last quarter, and just another metric to look at, oncology and CNS are the two biggest therapeutic categories. Just looking at, we track weekly IPOs. These are global numbers. We had 2 IPOs last week, which was great, both quite significantly oversubscribed and raising around 250 plus in terms of proceeds. So that's a positive sign. Brisk week last week for follow-on offerings, $1.25 billion across 19 transactions. That's the 3rd busiest week of the year, which is great. Venture market also strong last week, about 800 million raised across 39 companies. And 3 M&A deals announced, none of which had transaction value. So if you look at the value here, it looks like it's 0, but just because those values weren't announced. And looking at deals by quarter, of course, the Seagen deal, skews everything, so we've broken that out. But deals by quarter also, trending nicely with a little bit of a break in the summer. And then just looking across late-stage opportunities are accounting for about 35% of M&A, which is interesting because I would have expected that to be a little bit higher. So that's just a quick summary. And with that, maybe we can turn the slides off. And I'll move over and we'll have a conversation. First of all, does anyone want to start with some questions before I start? Okay, so let's start. So in terms of the market, it's been a tough time. How do we plan for the next 12 to 24 months? What do people think? Sam?
Apparently, I'm the analyst. So look, I'm going to come at it from the opposite direction.
Okay.
I started feeling a little bit more positive around March as the market seemed to gain some, I'm talking about biotech, seemed to gain a little bit of traction. There seemed to be some momentum. People were anticipating, maybe it's because it's the start of the year and they don't know what's going to happen during the year, anticipating M&A and that the M&A will drive interest back into the sector, which of course didn't really, for the sector as a whole, didn't really materialize. The M&A did. We did have some of the big deals and some of the smaller deals. And a lot of the companies that people were looking for being taken out did get taken out, and some surprises too. But looking forward, and so therefore, I'm a bit sad to be sitting here and looking at the S&P 500 Biotech. There's a ETF that follows it. I think you showed it up there. That's essentially the same level as in early 2017. During that period, people made a lot of money also. And then we had that bubble. I'm sure your chart showed it if you plot it over 5 years. So we're still at the same level. The S&P itself, compared to that time point, is up twofold, so 100%. And that is the problem. There's lots of profits in a lot of other areas. Sometimes some people need to cash those profits out, and in order to reduce their tax exposure is a good way of selling your losses, because you can offset them, depending on what type of investor you are, of course. And the reasons why we're where we are, I think, are still sadly there. One of them is the fact that we had too much. So a bubble usually, when it bursts, it doesn't come back that quickly. I thought with the 2008 bubble that will come back about the same sort of time frame now, but we've passed that. I thought that perhaps relative to the 2000 bubble will come back at the same speed, but we've passed that too. And I think we're dealing with still 183, was it, companies trading below cash, some of which are going to have to get rationalized, for want of a better phrase. But the problem of lack of cheap money is going to persist. I mean, only today we've got quite a few central bank decisions coming in the next week or so. Everyone's expecting them to, at the very least, not hike, but not cut. And then also you've got the issue of higher for longer. So when you can earn 4.5–5% on your money, just in, well, I would say on a relative basis, completely safe treasury world, why would you consider something that's got a high beta and you don't know when it's going to be able to actually give you a positive return? You've got that issue. Inflation, we've just seen what the oil price has been doing. Today it's taken a little bit of a setback. We're at $94. Everyone notices it by going and filling up their cars, assuming you don't have an electric vehicle. So we have that issue still going on. And there's a little hidden area that we've been looking at. How big it is, I don't know. But in terms of people's ability to spend money, which is a double-edged sword, right, for the economy, in that if people can't spend money, then inflation comes back down, which is good for us, is that insurance costs are going through the roof. I don't know if anyone's noticed it, but there's a lot of increases in vehicle, property, and not necessarily life insurance. A lot of it due to the fact that the climate change is driving a lot of costs for insurers, so they pass it on to payers. And a lot of this impacts companies too. Companies are getting much larger insurance bills than they used to do. And that's inflationary, unfortunately. So all of these things still exist. And I don't see how we're going to be able to get out of to really completely reset and get the XBI going again. I think everybody has to think about it from a perspective of a stock by stock perspective.
So quite fundamentally driven.
That's what I think, yeah.
Asun, how do you think about it when you are looking at investing at the moment?
Well, on the private side, we don't have such a strong impact from the markets, let's say. But what we have seen, in principle, we have a crossover strategy. So obviously the IPO window has been closed, and then we needed to readjust a little bit what has been our investment focus, and try to keep the companies funded with follow-on fundings until the IPO window reopens again next year in the market. And then we hope it will open again next year in the market. So we are seeing there are a number of crossover rounds that are aligning now, and then with this positive sentiment that things will slightly improve, we hope we can push these companies into the public markets, and valuations have also go down. They are more reasonable. We are also more careful what kind of assets we put outside, so that they can trigger the interest of not only healthcare investors but generalists.
Stephanie, can I come back to that? IPO window opening. What does that mean? Because at the end of the day, we have had IPOs. Companies are IPOing and raising significant chunks of money, right? It's not like some $50 million, $87 million. There's some magic numbers. I don't know how they work out. You probably can tell us, Stephanie, more. But what are you expecting to happen? Are you saying, or anybody, that you want it to open so that it's amenable to any type of company? Is that opening of a window, or even including, of course, you don't have any low-quality companies in your portfolio, but including lower quality, earlier stage, questionable stories? What does opening window mean?
I think this is a lesson we have learned from the 2021 hype. Like only mature companies should go out with very clear value inflection points that they will be really interesting to make an investment where you can kind of estimate what's going to happen, taking the risk of biotech that it always has intrinsically, but you can really have a clear an idea of the picture, how it's going to develop. Then obviously we have seen some IPOs last week, what is very positive, but we also realized that they were strongly supported by insiders. So this is also something to take into account. I mean, it's not the same to put a company on the public side that is totally supported by their already existing investors and really trading on the open market and see what happens with the company.
So that means generalists coming back in. That's what you mean by IPO window opening.
Yes.
Okay.
When we were talking, Asun, you mentioned to me that on the private financing side, there's kind of two sets of companies. There's the companies that everyone wants to pile into, and they end up being, quite competitive to get a seat at the table. And then there's a long list of companies where it's just taking a lot longer to close the round, if you will. Can you talk a little bit about, are there some characteristics in common of the companies that you find, are much more competitive?
Yeah, sure. What we have been seeing in the last year is that most of the companies go through very long periods of fundraising. So very difficult to close the rounds, very difficult to find a good syndicate. However, it was interesting to see some of the companies, the ones that have mature clinical stage assets with already preliminary efficacy data or very strong platforms. These ones, everybody wants to participate in this one. So I think now it's a little bit the situation is polarized, or companies that really struggle to find the money, or companies that really can choose who they want to have on the table. I think a lot of people outside.
And we also talked a bit, Dimi, about alternatives, right, in a tough equity market. That's part of what you're bringing, to the table for OrbiMed here in Europe now. Do you want to comment a little bit about that?
Yeah, happy to. I think if you look at what happened in the US last year in particular, there were enormous alternatives volumes, so private debt and royalty transactions that occurred partly, if not largely, as a result of the sort of shutting of traditional equity markets. And it's to date not been something that we've seen in Europe. I think partly because historically, perhaps that side of the market hasn't been as developed here. But I think it's certainly something that management teams, sponsors behind, boards behind them, and the ecosystem could do very well to start looking at. It's not going to work for all companies and all assets. The reality is that for some businesses, it won't be an option because we are talking later stage businesses, later stage assets. But for businesses that say aren't happy, we can put it that way, with their valuations, it's something that the US is very good at taking advantage of, and perhaps we're not so much here.
If I may ask you, the feedback that we receive from our fund managers is that they typically do not favor this kind of options because they have the perception that they may be riskier if the company doesn't meet whatever milestone they expect to meet with the financing that they acquire from this kind of other alternatives. And if they don't have the money internally in the company to support that delay or whatever, it's going to be even worse afterwards. So they kind of, at least the feedback that we receive is that they say it like as an alternative, but they assign a little bit of more risk to those when they don't have already enough financing in the company.
I think that is a very common, I think that's completely correct, and that is a very common attitude that we see in Europe. I think that's partly for legacy reasons, that in the past, a lot of providers of this type of capital in Europe have been opportunistic, shall we say, not to name any names, but I think part of that reason has been a lack of specialist capital. So, OrbiMed, we've just opened an office in Europe, in London. We have been active in Europe in the past, but not to the same extent as we intend to be going forward, certainly. And we're hoping to bring exactly that kind of specialist partnering capital as opposed to the opportunistic form. I think the sort of other leg to this is that when you look at the US and US businesses, US management teams are very happy to utilize this capital when they can. And I don't think it's any of us need, or I don't think it's a surprise to anyone in the room to say that the US ecosystem is so much more mature. Companies are able to raise so much more money, advance assets far faster, and ultimately, let's be honest, be more successful than businesses in Europe. And I don't think the two things are unrelated. I think it's a willingness of those management teams to take on that capital and back the assets that they have.
Maybe also true in equity, right? To take on, when there's money at the table, to take on more money rather than, and some of this may be shareholder driven, focusing more on dilution. I mean, there are a number of cultural differences between the US and Europe that we were talking about on our sort of pre-call. And, I guess the big elephant in the room is what you were just talking about, right? Which is that there is a much less developed market here in Europe. And so I guess the question is, do companies really, if they want to continue to build and grow and get the money to do that, do they need to shape themselves to be acceptable and attractive from a US perspective versus maybe a different perspective in Europe? Stéphane, you had the benefit of selling a multiple serial entrepreneur, successful, one of your businesses you sold to a US company, and you went and spent a few years out in California. What were some of the big differences you found, aside from maybe the weather?
That's a big question on many responses to this question. But I mean, I've often heard that the difference between the US and Europe is the access to capital. I tend to disagree with that because capital is moving around. So if you have the right project, the right business plan, whether you are based in France, Switzerland, or the US, you should find the same magnitude of money. I think, the difference is probably more cultural than anything else. I think there is a huge difference in mindset, not only on the side of the manager, but also on the side of the investors themselves. Too often I came across some discussion when we were discussing a term sheet with investors, European investors, and I had the impression to be in a grocery store. Like, they want to control everything. Every time you spend a little amount of money, they want to have control over it. Every time you try to recruit someone, they want to limit your capacity to pay, normal or market price salaries. In the US, I think people are much more relaxed because they know the cost of doing business, and the cost of doing business in our industry is very high. And I think this has not crossed the Atlantic yet. It's changing, but very slowly. It's not all the fault of the investors, obviously. I think there is a big issue as well with the pool of managers in Europe who are far less experienced than in the US in general, whom for most of them have never experienced success. who probably lack the ambition for their company or for themselves that you find very commonly in the US. I mean, in the US, and I'm sorry, this is a very general statement, you've heard it many times, but it's okay to make money. It's okay to make money by selling your business. In Europe, and especially in, let's say, a socialistic country like France, it's a little shameful to make money with your business. So when you start with that kind of lack of, ambition, that kind of very, let's say, timid mindset on both sides of the table, I think you are up to a very difficult start, to create value for yourself and for your investors.
So what can people do to get themselves, okay, do we agree that people need to be, or that companies need to be prepared to go to the US and have a sort of US access to capital? Shape a company.
Probably you don't necessarily need to be in the US, but you need to have a management team that has the US exposure. You like it or not, investors like to relate to people or to stories which they understand, which were successes, and you find those stories in the US, not in Europe, unfortunately, with a few exceptions, obviously. Okay, so I don't see, in my current business, half of the management team is based in the US, and every time I go on a roadshow in the US or in Europe, I take one of them because they will tell a story that the investor, know, and that was a success for the biotech community. You cannot do that, or it's much more difficult to do that with a European manager because, again, very few of them have had that kind of success. Okay, so it's not necessarily that you need to have a presence in the US, but you need to have a mixed management team, US, Europe, with some people that have that kind of track record that investor will be able to relate to. That's the way it is. You like it or not, that's the way it is.
Any questions? Yes. Or comments from the audience based on?
I'd just like to bring up the retail aspect because as an American who's lived most of my life in Europe, I find it astonishing to see how little people in Europe care about owning shares. So when I was growing up in the United States, Merrill Lynch had a slogan that said, "Buy a share of America." And of course, everyone went out and bought a share of America. But here, it's very difficult to talk even with your contemporaries about shares and a share portfolio. So I'm wondering whether that has to happen first before you can get the change in attitude at the level of the, and then to add on to that, whether the capital market reforms going on in the European Commission will make any difference.
Actually, what we have seen with our managers is when you have a relevant player in a specific region, you start having these kind of conversations because these big players, so to speak, or people who have been around for a number of years, they have had these kind of commercial relationships, whatever the type, with the US market, but not only with the US. And they bring those kind of conversations to their environment. So probably you're right. We don't have as much as in the US, those type of conversations. But I would say that there are at least a couple of countries in Europe where you are starting to have more and more that conversation, and it's expanding. Because again, when you have one player systematically talking about it, the rest of the people who are involved with them, they will start also talking about it, and they will start copying the same type of manner that they do business. But it's taking a long time, that is for sure.
I think I see another question in the back.
Hi, Alex Blythe, Lift Biosciences. I think it's a fascinating discussion, and I think it's very interesting when I look at Dimitrios' position for OrbiMed, a very well-known US VC, and the expectations that you might have of what you can get out of Europe. I think from my perspective, when I listen to this, I know lots of risk-taking European entrepreneurs. I'm one of them. When I go and pitch to a US audience versus a European audience, I use a different deck. We have patents across the whole neutrophil space for oncology. We own it. And I can say, look, we can run everything in parallel. We can do our manufacturing at the same time as we're doing early clinical trials. When we come out of this, we can hit the market early. We can get in 4 years earlier. This is what we can do, totally dominate the space. But that's going to cost, $30 to $50 million to get that going. Or there's the 15 million option where you run it sequentially. You run your clinical trial, you've shown it works, and then you'll spend your money on your manufacturing, blah, 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 blah. And literally, I call it the own the space versus risk mitigation. But really, it's a US versus EU pitch. It's that clear. And I don't think the problem really is the entrepreneurs here. I think the problem is that the financiers who've come through in Europe are what I'd call the survivors, and the ones in the US are the thrivers. And that's what I see over and over again. So I think my question for you as OrbiMed is your strategy now coming to Europe going to be that of a survivor or a thriver? Are you going to be taking more risk in really new to world therapies than other European funds are? Thank you.
So if you look at our current funds that we're investing out of, which are, aside from the Asia and Israel funds, are global funds. So they're US, Europe. If you look at and to be clear, we've invested in Europe in the past. I think we have about 50 or so European portcos currently. But if you look at the split in terms of dollars invested, I don't have the exact stats, probably a fraction of it, Europe, by value. Now, I think that will change with the physical presence here and opening the office, and that we expect that, I think, to go up. And I think it's important to, I guess, to your question, to note that our investment criteria are exactly the same. Whether it's a European business or a US business, we're looking for the same things. So I suppose the way to answer that is, yes, we're going to invest with the same mentality that we do in the US. That gives a quick answer to the question.
Asun, what do you think when you hear that?
I was thinking that I think there are obviously historical reasons as well why in the US there is more money and there is a different type of investment. We see Biotech, it came to Europe much later than the US, so it's historically an American business. The deep pocket investors are also in the US, and most of the expanding healthcare in the world happens as well. In the US, 60%, so there is a reason. And also, I was thinking that with less capital injection in the EU, you were talking about the ambition. Obviously, I think the EU companies are thinking more of a merchant acquisition than a Nasdaq IPO, obviously, due to the lack of capital injection.
Yes? Just one second, someone will bring you the microphone.
Coming. I just wondered, is there a difference in the US and the European regulatory market attitude that has an impact on it?
Do you mean medical regulatory?
In what sense?
I'm sorry. I mean, traditionally, I think European communities have smaller, more coherent individual infrastructure that's already well established as far as academic and regulatory circles, whereas the US is more fluid and free-flowing and younger. And also, it's a very big country which technically has a centralized FDA, but in fact, it's harder to know what's going on there. So I'm saying it's freer in the US. Is that a possibility?
I'm not sure I get the question or the point, but based on my experience, regulatory processes are quicker in the US than in Europe, definitely. But that doesn't mean that your clinical trial is going to be more rapid, because in Europe, at least in my business, we have the advantage of having very few centralized clinical centers. So you have an access to patient which is easier from that respect. Whereas in the US, it's by definition, because of the size of the country, decentralized. So yeah, quicker regulatory pathways, but at the end of the day, that doesn't mean that your product will make it quicker or more faster to the finish line. If it was your question. Probably not.
The European regulatory process is very slow and more tightly controlled.
Oh yes, that I can confirm. Definitely, it's very slow, but
Okay.
it's improving. It's becoming much more centralized, and we see things changing with less uncertainty. The big hurdle remains the timing. So now we know how long it will take, because there is like a maximum duration during which regulators, when you submit, for example, a clinical trial application, there is a maximum period of time, which I think is 5 months, during which the regulator have to respond to you, which was not the case before in most countries. But it's still 5 months compared to 30 days in the US, okay? So definitely when it comes to timing, it's a much longer process. But I think regulators are working hard as to trying to simplify things, which is already a good start. And I think the duration of the process hopefully will come later.
But I don't think that's something that impacts availability of capital to biotech companies. I mean, the biotech companies that we all know, when they develop a product, is for global markets. They might license it to somebody for US or China or wherever, but the speed with which they get their drug to market in Europe is not a determinant of their inability to raise substantial sums of money. I don't think that's...
No, you're right.
I don't think they're related at all.
No, and usually when you start clinical development, you think global anyway. You go on both geographies, and there are some technologies for which, funny enough, Europe has a much more open mind than in the US. For example, genome editing. So you see a lot of genome editing, companies based in the US starting clinical development outside of the US and sometimes in Europe. I mean, in the UK, in all fairness, which is no longer exactly Europe. But I think I'm totally with you. I don't think it will make a difference. And again, if you think your strategy well, you should be on both geographies.
One more thing. I think the problem is genetic. just to be provocative. Not really, obviously. But the entire US system, forget biotech. We have the same issue to a degree in tech, right? We have the same issue in innovations in other industries. It's not just biotech. The problem for biotech is we do have great innovation in Europe, no question, in other tech areas, in other areas of business. The appetite for waiting 10 years, 12 years, and the level of uncertainty just does not fit with the general average European attitude. It just doesn't fit. And I think it's 1998 that I joined the city in the UK. And I've been doing global pharma, European biotech, I've looked at US biotechs, I've gone through all sorts of iterations of my past. This question has been the same over the past 25 years now, right? It's not going to change. We need to, if you want to change it, you have to change the attitude of the investors, and I think that's not going to happen. So what happens is folks who have the money look for those people with the mutations, the ones who have been able to develop companies with assets that are genuinely interesting, exciting, not designed to appeal to a European necessarily investor base, but designed to get a drug to market. And we've got examples sitting here. I can see people in the audience that have done this. I don't think it matters then. To those people, the money, as you said, will find them, because that's what money wants to do. It wants to make more money. So you guys being in Europe, you're going to take advantage of some of these dislocations, but not necessarily with a company that's got a product that's probably never going to make to market, etc. So I don't think the question here is that. The question is, how do you design your company to appeal to the global investor as opposed to European or whatever? And of course, then your issue is, well, I need some money to start. I do understand the catch-22, but trying to solve the problem of Europe, I think that's behind us, to get over it and just find other mechanisms.
If I just add to that, I think that's entirely correct. It's not an issue with scientific innovation. It's not an issue with regulation. It's an issue with commercialization. So when you look at the stats of the number of new molecules, new chemical entities being developed historically by region, right? Europe versus US, they're not that different. There's as much innovation coming out of Europe, out of institutes, out of the universities, as out of the US, more or less. It's diverged a little bit in the last few years, but it's a commercialization story.
Yeah, if I may, Stéphane, add something to that. One of the cultural differences, which is very often overlooked, is the ability that in the US people have to kill very fast a project that is not going to make it successfully to the market. And in Europe, I'm amazed by how much public funding is going into zombie projects or zombie companies that have no future whatsoever, just because you need to protect jobs, just because you need to protect the university or whatever. And based on my experience, this is not happening in the US. When something is not working or not working enough to one day eventually be a commercial success, you just stop funding it and you close the shop. In Europe, I know so many companies that have been surviving for like 10, 15 years on a project that will never make it to the finish line. You know, piece by piece with, you know, some very insignificant public funding, those companies survive. And I think this is not good for the market because this is polluting the funding space.
But there is a reason for that. And the reason is that it's going back to what that gentleman said there. When you go and raise money, you're given, in the UK, you're given the sequential process, right? So you're given a small pot of money saying, look, make things work with this. Let's see how you get on. So of course you do your absolute best to try and get that asset over the line. You don't have enough money to invest in another asset. You don't have enough money to even do some research in some other areas. So you end up being entirely focused on that. And if you let that go, there's nothing happens in the company. So the issue is not the funders necessarily. The issue is that the company are forced into that place where they have to keep focusing on that one product. So you beat every possible path or to see whether you can get it to market. I agree with you, but I think that's the diagnostic as opposed to, I don't think people just want to carry on. I don't think they have a choice often.
Well, I kind of disagree because, again, I'm a strong believer in the fact that when you have a good project, wherever you are, you will have the money. I mean, you have the good project, the good team, the good business plan, you will find the money. And if you don't find the money on a project after 5, 6, 10 years, probably it's because the project is not good. There is something wrong with it. And yet, companies are surviving in Europe much longer than they should. It's a general statement, okay, I'm sure, exception to the rule. Good projects sometimes are not being financed. But when you are not being financed after so many years, start asking yourself the question, am I the right person for the project? Is the project the right one? Am I knocking at the right door?
I see we have a question in the back.
I'm sorry, I disagree. We're not in a perfect world. You see, it would be nice if we were in a perfect world, and then maybe I would agree with you. The issue is, it's one thing that is missing is also the depth of the market in Europe, i.e., when you've got funds following up, you've got no investors in Europe looking at fallen angels or hidden gems, right? When you've got a company that was listed too early or hit a hurdle and the market cap has gone down, no one's going to be looking at this. In the US, you have trouble as well, and you have enormous, incredible, sorry, I'm going very far here, in terms of legislation. When you've got a biotech company that wants to raise money, the majority required, the quorum required to raise money is not majority of the voters. It's actually majority of the entire capital you have. Now, you've got to get that when you're a small biotech company to survive. The problem you have there is that the Black Rocks and all the others that house the stock of the owners do not vote for these private guys. So for 3 years, I know a company, 3 years tried to get to vote to increase its capital, to survive, and couldn't. And what's the solution then? The solution then is to do a reverse split, because you're allowed to do that. So you do a reverse split, and you get a redeemable preferred share with one of those finance companies that, you know, are there just lending money quickly to make a quick return. So you reimburse it afterwards. And what you've done is you've just increased the down spiral of your share price. Now, I mean, the world is not perfect. And you've got this company that I'm talking about is actually listed. It's in your field to some extent, but without gene therapy, but it is in ophthalmology, quite big. It's got 8 of the top 10 companies in pharma really looking at its technology at the moment closely, but it's unknown or unseen or by investors. Hopefully someone at OrbiMed is looking at it. Thank you.
I think it's fair to say that there are some country-by-country restrictions about how things can be done, which are difficult. And I think if we had, more rationalization across the markets, both in terms of the markets, but also some of the regulations and the way things that can be done, I think that could help facilitate things. And that is a big difference vis-a-vis the US. There is a lot more corporate flexibility, I would say. I think we have time for one more question.
A very quick one,
Yes, okay.
if anyone.
Something I'd be interested to hear the panel's thoughts on is in a market which has had to become increasingly risk averse, and VCs, some of them are struggling too. So, I understand that position. What can happen is that things that are really breakthrough, potentially curative therapies across many different therapy areas, will struggle to get funding because they're going to require more evidence to convince people. They're seen as a higher risk bet. Something that many VCs will say is they want something novel that's, first in class. But when it actually comes along, they're going to want a lot more evidence to believe in it. And that evidence requires more money, and that money requires more evidence. And so you've got a chicken and egg situation that these companies are often stuck in. So I guess my question to the panel is, how in this environment should companies in that sort of space go about raising funds with VCs like those you represent?
I think there are some funds that are ready to take more risk if the technology is differentiated enough, if there is a good base of R&D behind. And then there are some other funds like ours that we invest a bit later when the technology is already validated in all the preclinical models. So I cannot think of a strategy that would be different from any other asset, small molecule, or any other more common technology, something more new, innovative, something like gene therapy. Will you be thinking about, or something like?
I don't know if I would fully agree with investors being more risk averse now. We have a fair number of funds in earlier stages. And for those, actually, what they look for is something that is completely different from whatever is already in the market. So typically, unique positioning, first type of products, and these kind of things, because it's the way for them to reduce the risk for subsequent follow-on rounds and attract additional investors in later rounds. So, and they have the money at the moment. The other thing is if we have enough of fund managers and funds in Europe to actually cover for the full process from the very early stage up to IPOs or all these other alternative financing that we were mentioning at the beginning of the panel, that typically require more advanced clinical trials and kind of data. And just one thing, I do agree with my colleague in the panel when saying that typically if you have a good asset, you can find the money. It's going to require time, but you find the money.
I think we're out of time. Thank you very much for joining us and for listening, and huge thank you to the panel for their participation. Thank you very much.